Welcome to another edition of Inside Investing. I'm your host, Jason Natick. We've got another great episode in store for everyone here today, where we're going to unpack one of the hot items in not only in the investing landscape, but also look at in the culture at large. Now, BlackRock is making a bold call on artificial intelligence. The world's largest asset manager calls it a mega trend that will continue to drive markets for years to come. One that could revolutionize our lives and our investment portfolios. Now, here in this episode, we'll hear where the pocket of opportunity may lie and how investors can gain exposure to it. Joining us here is Jay Jacobs. He's the U.S. head of Thematics and active equity ETFs at BlackRock. Jay, it's great to have you here with us. We appreciate you taking the time.
Jason, it's a pleasure to be here. Thanks for having me.
Anytime. Now, can you share a little bit about your own individual background in researching major themes in the markets, and particularly artificial intelligence, and how we might be able to develop them into kind of investing products?
Absolutely. So I've been investing thematically for over 10 years, which is really trying to look at what are some long-term structural trends that are disrupting major swaths of the global economy. What's great about doing this for 10 years is we've already seen some of these themes really go from really nascent ideas. Think about where electric vehicles were 10 years ago, even where artificial intelligence was 10 years ago, cybersecurity. So many themes have evolved so significantly over the last 10 years, and yet are still really early in their adoption curves. These trends take decades to fully play out. We like to look at them in this kind of S-shaped adoption pattern where they start out very slow. Usually the technology is not that great. It's expensive. People don't know about it. But slowly that technology gets better and it starts to accelerate and it gets cheaper and more people start to know about it. And all of a sudden it becomes a really massive world-changing theme. And we think we're really at the precipice of several of those themes impacting the world over the next several years. So I'm very excited to chat with you today about AI as one of those big opportunities, but also just excited generally about the opportunity in the markets today, because I think the market hasn't fully appreciated some of the disruption that's about to happen over the next 10 years or so.
Yeah, I'm excited as well. Just thinking about just the drop in time that AI has been around and kind of how much it's already started to change and evolve. So really looking to learning from you over the next little while here in our discussion. Let's focus here on a little bit on BlackRock itself. You've called AI one of the 5 kind of investment megatrends to watch. What's the investment thesis around AI, and why does your team feel like it might be such a game changer?
Taking a step back, we introduced our Megaforces framework in June of last year, and the idea was really, what are the 5 major forces that are going to impact everyone over the coming decade? And it doesn't matter if you are invested in ETFs or stocks or bonds or real estate or other alternatives. The reality is that these megaforces are having a economy and society-wide impact on the world. Mm-hmm. And so those 5 megaforces include AI and digital disruption. It includes a transition to a net zero economy, demographic divergence that we're seeing around the world between aging populations, the aging in developed markets versus several youthful populations. It's about geopolitical fragmentation and some of the rewiring supply chains we have around the world in kind of a post-COVID environment. And then finally, it's about the future of finance and how finance is evolving and different accessibility and roles that institutions are playing in finance. So AI is one of our top 5 megaforces in the world, and it's very clear why. This is a massive theme with a huge addressable market. It's not just about technology. This is about, how does AI impact healthcare? How does it impact legal services, consulting services, programming, autonomous vehicles, automation in factories? Really, every sector is going to be impacted by artificial intelligence in the coming years. That gives us a lot of confidence that this is not a fad. This is not something that is going to come and go in a few years. This is the beginning of a very long-term powerful trend. In fact, the way that we really think about AI is, this isn't one technology. This is a platform technology that many things will be built on top of. To provide a little bit of an analogy around that, you can think of another platform technology being 4G cellular connectivity. Before you had 4G, you had 3G, and it really allowed you to text people. It was a not very powerful technology. It was very hard to browse the internet. You certainly couldn't do things like watching videos. But when 4G technology came out, it let you be on social media on your phone, do e-commerce on your phone, FaceTime your friends. you name it, you had such powerful connectivity through your mobile phone that all these other applications and businesses started getting built on smartphones and creating really an entire economy around it. Artificial intelligence is like that. It is a big unlock for other technologies to thrive, whether it is how we interact with different services, how we interact with the internet, how other technologies are going to be built using artificial intelligence going forward. But this is a platform for a lot of economic growth. And again, that is really what gives us a lot of confidence that this is a mega force and not a fad.
I think AI could even be kind of like an amplifier of the other four megatrends that you've outlined in your theory as well. So.
Oh, I think you're exactly right. I mean, one of the most interesting kind of relationships between these two megaforces is aging populations and artificial intelligence. So, in aging populations, what you're seeing is in developed markets, you're seeing a slowing of the workforce. In the last 10 years in the United States, about 20 million jobs were created. In the next 10 years, we think it'll only be about 4 or 5 million. And that's because the United States is getting older. There's less youth to replace people who are retiring out of the workforce. So what that means is if you want to maintain economic growth, you have to do more with less, or you have to do more with the same amount of people. That comes down to productivity. How do you empower people to do more? How do you give them superpowers in the workplace? A lot of that's going to be driven by artificial intelligence. If you can remove some of the more mundane tasks that you do day to day because it can be automated, or you can have a virtual assistant, that frees you up to do more meaningful work. And suddenly with fewer people or the same amount of people, you can really continue to have economic growth. So I think there's really an interesting relationship between people getting older around the world and the importance of artificial intelligence driving economic growth.
All right, I'm excited to learn more about the case for AI as the next great investment opportunity. But before we get into our conversation, just a quick note to our viewers. We encourage you all to subscribe to our YouTube channel. It's TD Direct Investing, so you don't miss an episode of Inside Investing. Now, with that being said, let's continue our conversation. All right, now, Jay, your team there at BlackRock has written in 2023 that it was just the beginning for AI. What do you mean by that?
So it's a little bit provocative to say it was just the beginning, because in reality, AI has roots going back to the 1950s when Alan Turing came up with the Turing test, which was really almost a philosophical idea that at some point computers would get so powerful that they would be indistinguishable from humans. So he created this idea of a test that you have to be able to test computers to see if it's human or electronic. But fast forward into the later 1950s, General Motors came out with the first robot. You fast forward all the way to 2011, Siri showed up on our phones. 2015, you started having autopilot in electric vehicles. And so there is kind of a long history of artificial intelligence, but it's taken a long time to get from idea to concept. A major, major disruption happened at the end of 2002, which was the release of ChatGPT. And ChatGPT is a large language model. I'm sure many listeners have used it already. But the idea behind ChatGPT is it made AI accessible to large populations. You did not need to have a computer engineering degree. You did not need to be a robotic designer to use artificial intelligence. You just needed a computer and the ability to type. Because all of a sudden you can interact with ChatGPT, ask it to write poems, ask it to summarize an email, you name it. The use cases were tremendous. And what happened? 100 million people signed up for ChatGPT in 2 months, making it the fastest growing digital platform of all time. So clearly AI had this moment, not just in advancements in technology. Actually, a little bit of a side note, ChatGPT was not a major technological advancement. It was a major social advancement that allowed so many people to participate in this AI revolution. And now we've seen an explosion of growth. We've seen massive investment in the artificial intelligence space. We've seen competitors to ChatGPT come out. We've seen new editions of ChatGPT coming out, like GPT-4 and now 5. And this is really setting off a cascading event, series of events that is making artificial intelligence really have this renaissance. What I think will be the major shift from 2023 and the first part of 2024 to the next year or so is this is going from proof of concept to a commercial product. ChatGPT was really a proof of concept that people would want to interact with AI, that people would figure out how to use AI, but it really hadn't been monetized yet. What we are starting to see now is that companies are integrating ChatGPT into their processes. They're licensing these platforms. They're applying it to their proprietary data. They're developing products that consumers can use that have AI embedded into them. Think about travel websites that can build itineraries for you using artificial intelligence. This is a major step forward because it means it's not so much about how good is the technology. That already has happened. The technology is great. It's about how do these companies make money leveraging AI. And I think that chart that you're showing on the screen here is really important. There's really two sides to this. One side is you can use artificial intelligence to get more efficient. That means you can reduce costs or you don't need to hire as many people because AI can be that assistant. And another piece of it is that artificial intelligence can make your product better. It'll get people to spend more money on your product. Going back to that travel website that builds an itinerary for you, if it makes it easier to plan a trip, more people are going to take trips. If it makes it easier to book reservations at great restaurants, people will go to more restaurants. So the idea that AI not only can be an efficiency technology, but can also be a revenue driving product is really important as we move from this proof of concept stage that we've been in to a commercial stage where AI should really generate terrific revenues going forward.
All right, let's continue to pull on that thread. We talked about monetization. That was a huge step for X, formerly known as Twitter, as well as kind of the meta companies. What's the next phase in the monetization and development for AI systems? How quickly might that occur in your opinion?
Well, really, the next step is reaching kind of multiple modalities of artificial intelligence. So, a lot of what people have probably used if they use ChatGPT is text to text. You type in, "I'd like to write a poem about artificial intelligence," and ChatGPT will come back with a beautiful poem. When you can start mixing multiple modalities, when you can start asking AI, when you can feed a picture into AI and say, "Describe this picture to me using text." Or if you can type in a text chatbot, "I'd like to develop a picture that looks like myself in a webinar," that starts to introduce new modalities. Now, that already exists to some extent, but the more that you can transition between text to image to video to maybe even 3D images, all of a sudden this becomes an even more powerful technology. And that's where a lot of the innovation is happening today. It's around how do you kind of create a more generalized large language model where it doesn't matter how you interact with it or what medium you're interacting with it in, it can play in all these different fields. It's an incredibly powerful technology that we're really starting to see massive development in.
I know your team at BlackRock has discussed the importance of what we're calling the tech stack when evaluating AI opportunities. Can you help us understand what that means?
Absolutely. So I think one of the important things about artificial intelligence is I'm guilty of this. I call it a technology. The reality is artificial intelligence is a collection of technologies. In some ways, it's these large language models that we've been talking about, like ChatGPT. In other ways, it's automation technology that's powering robots to do things on factory floors or in warehouse distribution centers. It includes machine learning that can train new algorithms. So there's a lot of different iterations of artificial intelligence. And one of the ways to make sense of all of this and to think through who participates in artificial intelligence, and most important to investors, who can win from the growth of artificial intelligence, is to look at it as a tech stack, the multiple technologies that are aligning to create these artificial intelligence products. At the bottom of the stack, you see more hardware. This is really where semiconductors live. So it really doesn't matter what kind of AI you're running, whether it's a large language model, whether that's a ChatGPT model, whether it's a Claude, whether it's from Anthropic. It doesn't matter. They all need really powerful semiconductors to be able to train these models to be able to do really powerful things with artificial intelligence. On top of that, you look at more of the infrastructure layer. This is, where's all that semiconductor power being housed? How is it being supported? It needs cooling, it needs electricity, it needs security. Most importantly, it needs data. Data is the fuel that powers a lot of these artificial intelligence programs. And so all of this kind of exists in an infrastructure layer that's incredibly important to artificial intelligence. And then on top of all of that is really the application layer, which is how is artificial intelligence being used? What products is it being infused into? How are we finding new use cases for artificial intelligence going forward? So this tech stack really is designed to pull apart the different parts of the value chain of artificial intelligence and to make more sense of what's really a collection of very powerful technologies from an investor perspective, because different parts of this tech stack are going to benefit at different parts of the market cycle and at different parts of the adoption of artificial intelligence going forward.
All right, we've got a well-timed audience question from William. That's a great follow-up to your answer there, Jay. He asks, data processing and robotics are two branches of AI. They might be some of the more obvious branches. Can you maybe get into what might be something that might not be as quite so obvious that's reliant on AI. Kind of one that comes to mind for me is maybe like utilities and things like that, power generation, because there's such hungry for hydro and things like that. But love to hear your answer on that.
Yeah, I think you're exactly right. I mean, when you look at the value chain of artificial intelligence and what is required to run it, electricity is becoming a really big challenge. So a lot of these chips that are used for artificial intelligence are 4 times as power dense as previous generations, meaning you need to multiply your power consumption by 4 to be able to run the latest GPUs. And so power is a really important part of the value chain as well. But if you're thinking about what are the use cases of AI, it's really limitless. I mean, one of the opportunities that we see as really one of the biggest areas of disruption for AI is in the healthcare space. This takes a lot of different forms. So one form is how do you manage hospitals more effectively? Hospitals are kind of a symphony of chaos, right? You have emergency rooms that are staffed with doctors and nurses. You have all these medical devices that are moving around and different patients that are moving around, and a lot of just managing inventory and managing people can make hospitals so much more efficient. It's a really challenging problem for humans, but something that by capturing data via artificial intelligence, whether it's cameras in an emergency room tracking where people are and what's being used, suddenly you can make much stronger inferences about maybe we need this number of doctors on a Monday versus this number of doctors on a Tuesday, or we need this number of stethoscopes. You name it. You can kind of go wild thinking about it, but you can get a lot more resource efficient in how you run a hospital. The second piece, which is absolutely in the healthcare space but is very different, is the development of pharmaceutical drugs. Right now, the average drug takes about 10 years to develop and $2 billion of investment. We believe artificial intelligence can cut both of those in half, getting new drugs to the market faster and a lot less with a lot less expense, because in a lot of ways, artificial intelligence is really just a better way to research these things. You have all these different drug compounds that can interact with different ailments in people's bodies and with different genetic compositions. It is a very hard math problem that AI is very well suited to solve. And if AI can do that better than humans, or at least assist humans in that research, you can remove a lot of that time and cost from the process. So this could have tremendous impact on our everyday lives if people start investing very heavily in artificial intelligence from a healthcare perspective.
Yeah, it's interesting to think about healthcare. So you think of it so disconnected from AI, but there can opportunity to have a lot of cost savings and bring a lot of efficiencies, and kind of coming where we've just come from over the last number of years, being prepared for future events and future enhancements and the aging population, as was one of your mega trends. I think this all ties nicely together. All right, great. So let's continue here with some questions here. So where does your team see the biggest opportunities to invest in the AI ecosystem here at this point today?
At this point today, the most interesting area is where the revenues are flowing today, and that is at that hardware level. We are seeing it with semiconductors, predominantly people that are manufacturing GPUs or graphics processing units. This is the common denominator. As I was saying before, if you are building an AI model, you need to train it using powerful graphics processing units. But while that's gotten a lot of attention today, we expect to see a broadening across the semiconductor space over the next several months, because yes, you need those GPUs, you need these really high-end, powerful, power-hungry chips to train AI. But when you have these models that are up and running, they run a little bit differently going forward. It's kind of like when you learn calculus or you learn some really difficult math problem for the first time, it takes a lot of brain power. You're sitting there, you're trying to think through it, you're getting tired, you need to have a break and a snack and come back, learn it a second time. But once you get the hang of something, you're just running problems over and over again, and you're just getting very efficient at it. So when we're in this training stage of AI, it really relies on graphics processing units. But when you're powering AI to just start running that model on an inference basis going forward, you can use more generic chips off the shelf. It puts more emphasis on just data collection. You've trained the model, but now you just want more data to run through it. So that's about memory chips, power management chips to get more power efficient as well. So right now, if you look what's happened in the market, a lot of the focus has just been on a handful of GPU manufacturers, but we see a much bigger opportunity broadening out across the semiconductor space as AI becomes a little bit more of a daily process rather than this kind of transformational training model. I think on top of that, you can also look at the infrastructure layer as well. As we see more artificial intelligence demand, we're going to have to build more data centers. There's going to have to be more services in those data centers, providing the power, the cooling, the security to all of those chips and all of that data. And so this is a really important layer as well, which is already starting to see a lot of revenue growth as we see AI demand picking up. So the today opportunity, the most immediate opportunity, is really at that hardware level for semiconductors and digital infrastructure.
Now, you've talked about the need for kind of investment dollars coming into the AI space. But that's going to require kind of a commitment from like the population at large. How do we see like popular culture weighing in on the AI space? Like it's been in, movies for as long as we can remember, Terminator 2, you mentioned, Alan Turing with The Imitation Game, even Ex Machina might come to mind. How does popular culture weigh in on the investing side of from an AI business case?
There's been a fascination with AI for several decades. That's certainly the case. I think part of the amazing aspect of ChatGPT though was that it didn't just exist in stories anymore. This became a product that we could use in our everyday lives. And I give some credit to Siri and Alexa, and I give some credit to advanced driving tools that can give you autopilot in certain cars. All of that is making us more comfortable with artificial intelligence every single day. So I think pop culture, is kind of a leading indicator here of where, where we were going to see more AI in our everyday lives. But it's not until you really get to roll up your sleeves and use AI that you start to understand it. Now, this does impact what's happening in the everyday world, though. A really good example here is when ChatGPT first came out. New York City public schools, within a couple of months, actually banned the use of ChatGPT. They said, we don't want our students using it. This technology is going to result in people writing essays and cheating on essays and not really being able to learn how to write and do these other things. A few months later, they came back and they reversed that policy because they realized if you're going to be a worker in the 21st century, you need to you need to know how to leverage this tool. It's like a pencil. It's like a calculator. You can't go through your life not knowing how to use this tool. That doesn't mean it replaces the ability to write. It doesn't mean a calculator replaces the ability to learn math and understand it. But you need to learn how to leverage these tools to be, at the cutting edge. And so I think that a lot of the fear around artificial intelligence has resulted in some kind of snap reactions that actually are not the right way to react to it. We should be viewing this as a tool. We should be getting all generations, but especially the next generation, very familiar with it because this is going to be on their desktop for their entire careers.
All right, so we've talked about seeing a lot of immediate investment opportunity. You mentioned GPUs on the hardware side of things in the immediate term. But what about a longer term scale, such as AI interference becomes, or inference rather, becomes more widespread?
I think a really interesting area for long-term opportunities is going to be in the software space. And I think this is where it requires an additional level of nuance because some companies will benefit, whereas some companies will be disrupted by artificial intelligence. Why is this the case? Well, artificial intelligence and these large language models like ChatGPT, they're not just good at writing poems, they're really good at coding because coding is a language and you can train large language models on any language, not just English, but other coding languages. And it has really become a superpower for software engineers, that there are things that software engineers can do with 3 people that used to take 10 people to do. And so you can have a really rapid software innovation now using not that many engineers going forward. And that means that if you were a software company that really had a moat around you because nobody else had just programmed that software yet, that moat might not be as powerful anymore. Someone that could have been 5 years behind you is suddenly a year behind you or 2 years behind you. And that really presents a big risk to some software companies. On the other hand, because you can do more with less in a space where software engineers are very well paid and there's very low unemployment, frankly, there's shortages in software engineering right now, you can do more with less and you can innovate more quickly and develop new products that can generate more revenue. So you can see how there's kind of this split where some software companies, I think, are going to leverage this to get more efficient and develop more products more quickly. Other software companies are going to realize that whatever software they developed in the past is actually not as distinct or valuable as they thought. And this is where I think really being kind of active in how you think about a specific space like software is important to differentiate between those winners and losers.
All right, with that being said, there's bound to be a lot of disruption in the software marketplace as AI becomes more widespread. How does BlackRock think about picking winners in this space?
Yeah, so it really comes down to who's going to leverage this technology best to provide a better product or to get more efficient. We talked a little bit about that example of travel companies, where if you can get people to book more trips because you have artificial intelligence helping them develop an itinerary, that's a great revenue driver going forward. And I think if we look at across a lot of software companies and a lot of internet companies, we'll realize that some small advancements in artificial intelligence can have a huge impact. Another area where this could be really impactful is in the streaming space. So, when you log into your streaming service of choice, it is recommending the next TV show or next movie for you to watch. I don't know about you. The hit rate for me tends to be pretty low. I don't know if I just have unique tastes, but I feel like those recommendation engines are not really dialed into my preferences yet. But as artificial intelligence gets better, it'll better understand me through my data and consumption and
Mhm.
recommend better movies and better TV shows. Or even better yet, it'll inform those streaming services of what TV shows and movies they should be developing. And maybe even because of the multiple modalities of large language models, it can rapidly create new TV shows that are very specific to certain niche audiences. So suddenly it's not, if you go back in the history of television, you used to have these broadcast television shows that were trying to appeal to really broad audiences. In the future, you just could get more and more specific television shows or movies for very niche audiences, and that'll be the first thing that's recommended to you in a streaming service. So anywhere where big data exists and anywhere where that data is proprietary to that platform, there's tremendous value to be unlocked via artificial intelligence. So that's really one of the keys that we look for is who owns proprietary data that can be used to make their product better or more powerful. It's streaming services, it's some software companies, it's some of those healthcare companies that we were talking about that have tons of data that they haven't fully leveraged yet. And we think that AI is really going to help monetize what is really kind of a scarce and unique and valuable resource in data.
All right. Now, what could the disruption from AI mean for revenue and earnings growth for companies that are able to develop and effectively leverage the technology?
It cuts both ways, right? So if you're in a growth market, you really want to be growing top line revenue. And I think a lot of companies are already looking into this. How do we use artificial intelligence to build better products that we can charge more for? Think about your desktop. We're seeing artificial intelligence already brought into search engines, being brought into word processors, being brought into presentation deck managers. All of those things, that's not just happening through the goodness of technology's heart here. They want to make a better product that they can charge more for. So I think that we're going to absolutely see top line revenue growth through the integration of AI into existing products. On the other hand, if you have kind of nonlinear scaling with product development through artificial intelligence as a resource, I think this is really key as well. That was a word jumble. What I mean by that is if you want to double the amount of products you develop as a tech company, but you don't want to double the amount of software engineers, artificial intelligence can make you a lot more efficient. So that's the other way that I think revenue and profitability are connected in artificial intelligence here, which is you have a lot of growth companies that want to develop more products. They want to develop those products faster. They want to get them to market. Artificial intelligence is going to help enable that and do it in a way that is really able to control costs and be more efficient as well. So I think there's just tremendous opportunities, not just at the revenue level for companies, but in overall profitability as well.
All right. And as a follow up to that, do you think we'll have an ecosystem of a bunch of different smaller AI platforms or a few larger platforms that dominate this space? Kind of like, or like, I guess getting to the point, do you think there's going to be a lot of M&A activity in the AI offering as we move forward as well?
The short answer is sort of yes to all of those questions. I think at one end of the spectrum, what we've seen in so many technologies in the past is winner take all or winner take most markets. How many search engines do we use? How many smartphone manufacturers exist? How many social media platforms? There's really kind of a handful in each of those different buckets. So we would expect for these large language models, these big platforms that are developing artificial intelligence, it'll probably come down to just a handful that really are the market share leaders. However, beyond that, when we go back to the tech stack, there's so many different ways to apply those large language models or those different AI platforms to unique use cases. And this is where I think there's going to be smaller companies that really start to thrive. What if you're a company that solely focuses on how to use ChatGPT to make better legal contracts cheaper? So you have a specialty in the legal field, you have a few lawyers on staff, you know the clientele of who wants what type of legal documents. And so you're using ChatGPT as the platform behind this. but maybe you're infusing it with your own data or your own inputs to be able to craft really good legal documents and sell that into a very specific market. So, I don't know. That's probably a smaller mid-cap company. You could think about an iteration of that that's just focused on the healthcare space. You could think about iterations of that that are just focused on the software engineering space. So I do think we're going to see an economy of smaller players that are taking these large platforms and applying them to really specific parts of the economy. And then ultimately, do these small players get bought up? I think that's also a possibility as well. But this is the likely path forward for artificial intelligence. It's not that everyone's going to understand how to use this off the shelf on day one. You need these smaller players that can take these AI platforms and apply them to really specific use cases.
All right. So want to be an equal opportunity here. We've talked about a lot of the benefits as well as some of the investment opportunities. Now let's talk about some of the key risks to AI's widespread adoption and the development for investors. What do you think about that, Jay?
Like any new technology, there's absolutely just risks in technological adoption. We've seen other periods of AI's development where it seems like there's a huge unlock and then it slows down. Think about when Siri and Alexa came out, really splashy, really exciting. And then, we realized the use cases may have been more limited. So it took a little more time for those technologies to develop. AI will not be, one way in its accelerated growth. I think we're going to see kind of fits and starts. But a more specific risk to artificial intelligence, I think, is cybersecurity. So at its heart, artificial intelligence is making data more valuable. It is taking data that is unstructured and making it structured. It is taking data that hasn't been analyzed and turning it into valuable outputs. Think about, what TV show I'm going to watch next. It's making that data more valuable if it can be more predictive of what TV show I want to watch. The problem with more valuable data is more people want to steal that data or disrupt the processing of that data. And that's where I think cybersecurity is going to be really important. This isn't just about what TV shows I watch. If you think about proprietary data across the economy, healthcare data, for example, if that becomes more valuable, people will want it for various different reasons. And so I think, at the top of the show, we were talking a little bit about themes that are happening in kind of tangentially to each other, that aging populations and artificial intelligence are actually kind of intrinsically related. I think the growth of cybersecurity and artificial intelligence are intrinsically related as well, because as data gets more valuable through AI, cybersecurity has to keep up to play defense against bad actors in the space.
All right. Now, BlackRock is one of the ETF providers that offers thematic ETFs focused on AI. Why do you feel investors may want to consider gaining exposure to AI through these products?
One of the challenges with AI is that people know of maybe a couple of names. I know there's been a lot of focus on the Mag 7, or maybe realistically, what's the Mag 4 this year, of companies that develop semiconductors and companies that develop some of these large language models. But the reality is that's just the tip of the iceberg. There's dozens, if not well over 100 companies around the world today that are playing a really important part of the AI and robotics ecosystem. So a thematic ETF is really designed from the bottom up to capture the entire opportunity set of a specific theme, not just even looking within one sector or even just within one geography, but looking around the world at the leaders in a specific theme like artificial intelligence. So this gives investors a lot more diversification. It doesn't matter so much just how the top names perform, but how does the entire basket perform? And also it makes sure that you're planting a lot of seeds. We don't necessarily know who will be the leading AI company 10 years from now. But we think it's very likely, if you're casting a wider net across several dozen names around the world today, that that the likely AI leaders will be a part of that ecosystem. So that diversification, getting exposure to the entire value chain, not just a few household names, is really important for thematic investors to make sure they participate in the theme and manage their risk.
That seems to me all the more important if you're casting that broad net. You were talking about the adoption of ChatGPT of the, just a few months in terms of 100 million subscribers. So there could be somebody else out there that's going to rise to prominence in a very short period of time. So yeah, good thought. All right. So if an investor wanted to gain exposure to kind of the AI mega trend using ETFs, how might they want to think about selecting funds based on the way the industry is developing?
So there's different ways to think about it. So we talked about thematic ETFs just now, which are really designed to capture an entire value chain. And really for a lot of investors, that's going to be a great way to play something like artificial intelligence. Don't try to get too picky or too granular. Own the entire value chain and benefit from a rising tide within artificial intelligence. However, we do see some investors want to get more granular, looking specifically at different parts of that value chain or different parts of that tech stack where they see opportunity. We talked about it earlier. Semiconductors really play a really important part of this ecosystem and are generating revenue today in artificial intelligence, which not all companies are. That can be a really specific layer that people want to get exposure to, and they might use a subsector ETF to get semiconductor exposure, or to get digital infrastructure exposure. You can get just exposure to the handful of companies that are participating in that layer. I think one of the important things for investors to think about, though, is not just kind of what they're buying, but where does it fit in the context of a diversified portfolio. AI is a tech-heavy theme. We're talking about semiconductors, we're talking about digital infrastructure, we're talking about large language models. Yes, there are some names in healthcare and other sectors, but I would say, largely speaking, over 50%, if not even close to 80% of the names really in the artificial intelligence space are some form of technology company. So it makes a lot of sense. If an investor wants to get exposure to AI, you might want to reduce your tech sector exposure or sell down an exposure within your portfolio that's already tech heavy and replace it with an AI specific thematic ETF. That's one way to get exposure. The other way is to think about the core of your portfolio where you have really broad exposures across the United States, Canada, globally. You can shrink that core a little bit. Maybe 80% of your portfolio is core holdings, and you carve out a thematic basket outside of that, which you're going to recognize as this is for long-term investing. This is going to be more volatile because it's not as widespread as the core. This is kind of a subset of companies. And I'm going to pick a few themes to diversify across and really have kind of this long-term growth generator for my portfolio. And that's where AI could sit. It could sit alongside other themes. We talked about demographic divergence. We talked about transition to net zero economy. You could pick a few themes in that bucket and try to diversify so you're not all in on just one disruptive trend.
All right, let's pivot to a question from the audience. This one's coming to us from Bruce. Bruce says, there's so much investment piling into AI stocks. Do you see a risk of investors overpaying for technology that can't meet sky-high expectations?
I think the risk we see in the market today is too much concentration in a handful of stocks. And this is a big difference between when you look at kind of the Mag 7 versus when you look at the entire value chain of ETFs. The Mag 7, a lot of those companies have had a very significant run up in the last few years because of AI exuberance. But as I mentioned, there's this long tail of dozens of companies in the AI space that haven't benefited, whether they are other semiconductor manufacturers, other digital infrastructure companies, other AI application developers, these data owners that own really valuable proprietary data. They have not experienced this bubble as much, if at all. In fact, some of these companies underperformed the broad market benchmarks last year, even despite AI exuberance. And that's because simply the market hasn't fully realized that these are artificial intelligence companies. So there's a risk of being too concentrated in these popular names. But if you look more broadly across the value chain, that diversification, that breadth of opportunity, that risk is certainly lessened. So, for investors listening to here, I would say, don't just focus on those top names. This is not a stock story. This is an economic story, and you should be getting that exposure across the value chain.
All right, you've mentioned Magnificent Seven a couple times. It's in the news quite a bit. And the next question comes to us from Ashley. She's got a very pointed comment about the Mag 7. The tech stocks have more money than they know what to do with. Won't they just buy up all the AI innovation to maintain their dominance? What's your thought on that?
They are using their money wisely in the AI space. And what I mean by that is you really need a few different ingredients to succeed in AI right now. You need a lot of AI engineers or a lot of software engineers to build these programs. You need a lot of valuable data. And then frankly, you need a lot of money because these chips are not cheap and running these chips is not cheap. So it's no surprise when you look at the Mag 7 that a lot of these companies are large cap tech companies. They have engineers, they have data, and they have a lot of access to capital. But again, this is still the early stages of AI. It's the early stages where new models are being trained, where we're still developing a lot of this technology. As it broadens, the opportunity set is going to go far beyond those big names. So yes, I think absolutely will the Mag 7 be acquisitive in the space and buy up some small caps? I think that could absolutely happen. Does regulation come into the space to prevent that? That's also a possibility. So, this is early stages, and I think this ecosystem will evolve significantly over the next 10 years with new companies entering, getting acquired, some companies failing too. This is a part of the adoption process of seeing winners thrive and losers not being able to make it. Let's look at any technology in the past. Let's look at e-commerce. Let's look at the internet back in the 1990s. Some of those early leaders were not necessarily the Mag 7 of today. They've been fully replaced. And again, that's the importance of diversification here.
Now, when BlackRock's thinking about a thematic AI ETF, when we're thinking about its construction, are we thinking about looking at market cap? Are we thinking about sector specifics? Or maybe kind of talk us through your thought process on that portfolio construction?
The driving principle is getting purity to the theme. We want to be owning the companies that are leading in the theme, no matter where they sit, whether they are classified as a tech company or a healthcare company, whether they are in the United States, Canada, Europe, Asia, whether they're a small cap, mid cap, or large cap. We really are focused on what are the pure play companies in this space. Now, that's how we select the companies that are included in these funds, but also we want to make sure we're providing diversification. So one of the problems with the Mag 7 is these companies are so big that in market cap weighted indexes that tilt their exposure to bigger companies, they just dominate the entire exposure. You could have 50% of your portfolio is just weighted in those Mag 7 names because it's market cap weighted, and these are multi-trillion-dollar companies. So we don't just think about what companies we buy, we also think about how do we plant our seeds across that portfolio. And one of the ways we do that is really just by trying to cap exposures so no one company completely dominates a specific index. That gives us more diversification. It plants more seeds across the basket so that if one of the Mag 7 disappears in 10 years, which is totally possible, it limits the damage that puts on the portfolio. Also, if the Mag 7 keeps growing, we do have exposure to those names as well. So it's really about balancing these trade-offs between being overly concentrated and diversification.
All right. Now, I know the word bubble can sometimes be a little bit of a four-letter word in the investing space, but there's been lots of hype around the market with AI, and we've seen tech stocks, skyrocket very recently as a result. How much of a risk do you think there is of a bubble being here from an AI perspective?
I think for investors taking a long-term view of AI, that risk is pretty mitigated. This is a multi-trillion-dollar economic transformation. Some estimates have this being $15 trillion of economic disruption due to AI. So whatever valuations we see today and the size of the companies involved today pales in comparison to the entire economic opportunity. Now, with that being said, could we see a sell-off in the next 6 months where some of these names come back pretty aggressively? That's always a possibility. Could we see volatility over the next 10 years of ups and downs? Absolutely. That's par for the course in these themes that are still early. The market is simply still trying to price what is this theme worth? And oftentimes we find the market underprices them. That systematically people are too short-term minded and don't recognize the 10-year opportunity. They're just looking at the 2-year opportunity. However, we do continue to think that over the long term, despite that volatility that we are certain will be there, this continues to represent a huge opportunity for investors.
Now, kind of focusing back on the tech stack a little bit, thinking about companies that are enabling AI, or think about companies that are maybe supporting its use, and there's even companies that are using AI. Is there one particular area that you see the most value in?
The most value is also where there's the most uncertainty, which is at that very top level of the tech stack, the applications. What industries are going to be built using artificial intelligence? Again, let's go back to the analogy of 4G that I was mentioning earlier. The big winner of 4G technology was not necessarily the telecom companies that developed 4G. It was the companies that learned how to harness it and to develop new industries, a mobile social media world, a mobile e-commerce world. All of these industries were completely revolutionized by 4G. So I think in the application space, AI will have a transformative impact on several different industries. We can make informed guesses. We've talked about several of them, from healthcare to consulting services and legal services and programming. But there's also companies and industries that are just getting started using artificial intelligence, and I think that's where the opportunity is, but also where some of the risks are, because it's still so early. I think anyone who says they know with certainty how this is going to play out is bluffing. We have to see how this is going to play out, and we have to see the new industries that are going to be built using artificial intelligence as their platform technology.
So remaining nimble, but kind of to see what comes next, right? All right, great. Next question. This one comes from the audience. We have one from Stephanie here. Stephanie asks, what's the most effective financial metric that you use in evaluating AI equities?
I think the most valuable metric is really growth. Because we are so early in the growth stage of these companies and top line revenue growth specifically, we're so early in these companies. What we want to see is that they are taking this incredible technology and they are commercializing it and they are entering into a large addressable market. So if you are where we see this today is in semiconductor companies. They're seeing tremendous top line revenue growth because there's so much demand for artificial intelligence. They are rightfully charging a lot of money for these semiconductors because they're very valuable. They're selling them as quickly as they can make them. They are really driving a lot of top line revenue growth. As we look, kind of around the different parts of the tech stack, we want to see that as well. This is that shift that we were talking about from proof of concept to commercialization. Who is able to take this incredible technology and sell it and make money off of it? And so if we see that high top line revenue growth, I think that's a really important metric that this company is doing something right about harnessing this technology. Now, revenues in isolation aren't the answer. What you really want is profitability, but not necessarily at this stage. When there's such a high growth opportunity ahead of these companies, they're not trying to pay a dividend to shareholders. What they're trying to do is reinvest that revenue, reinvest that cash flows in their business to develop the next iteration of their semiconductor or to develop the next iteration of their software platform to sell to even more people. So that's why early on in the early stages of a theme like artificial intelligence, we want to see high or increasing top line revenue growth. Earnings will come down the road. And 5 years from now, when we do a webinar again on this, I'll be talking about earnings, but right now it's revenue growth.
That was going to be my follow-up to that question. Is it a 5-year, 10-year, 15-year time frame that one can realistically expect or look for profitability, or is it too early to tell and put an actual number on that?
Different parts of the tech stack will be at different stages. I think when you look at those lower parts of the tech stack and hardware and digital infrastructure, I think that's 0 to 5 years where we're going to see profitability. When you look at those applications, when you look at the large language models, you look at some of the data, that could be maybe 5, 10, 15 years out. But that's okay. I mean, some of the Mag 7 stocks today took a very long time to be profitable, and that was by design. They wanted to grow as fast as they could into as large of a market as they could before they focused on profitability. And I think in artificial intelligence, you'll see a similar pattern with a lot of these companies. It's going to be grow as fast as you can into as big of a market as you can, and then focus on profitability 5, 10, 15 years from now.
All right, great. Our next question comes to us from William. We know AI is a very hot button issue, and so is green energy. So William wants to understand how AI can be disruptive in the green energy space.
Well, AI is both a consumer of energy as well as potentially a use case for how to get more efficient with energy. So we were talking about this earlier, but AI is very power hungry. It requires a lot of power to run these semiconductors. So one of the ways that we should be thinking about this is how do you manage your power mix to run all of these really powerful data centers going forward? Power consumption in the United States for the last several decades has basically been flat. It's been very little growth despite population growth. And a lot of that has to do with a shift from really from manufacturing to services in the United States, which is less power hungry. But all of a sudden, we're seeing power demand start to tick up again. And it's because of electric vehicles. It's because of artificial intelligence. It's because we're seeing some manufacturing growth again. And so we do have to think about how do we bring incremental net new power to the grid, and how does that work with other technologies like artificial intelligence? So absolutely, there's going to be more power demand for AI. But I think maybe the nature of the question is how can AI be applied to be more power efficient? Some of these things are really simple, right? How do you optimize buildings to use power at the right times? How do you put more sensors in buildings to turn off lights when people are not around? How do you do cooling in a better way because you have better anticipation of what the weather is going to be a day before, and you can start heating a large building or cooling a large building as necessary? How do you control traffic patterns more intelligently because you're able to modify your infrastructure in a smart way where it's changing the frequency of green lights versus red lights, or changing the number of lanes in each direction in a very smart way using artificial intelligence. So there's a lot of ways you can use AI to get more efficient, not necessarily about producing more power using green energy, but how do you get more efficient with the power you use today using artificial intelligence?
All right, so we've talked about one hot button issue in terms of green energy. Let's move on to another thing that's making a lot of headlines. How can AI and crypto, how does something like that intertwine itself together?
You know, there's different ways that these themes are related. You know, my view is artificial intelligence is, you know, we've talked about this with our mega forces, right? We have our future of finance framework, which crypto and digital assets fits into, whereas we have artificial intelligence and digitalization in another part of the mega forces framework. I think they can collide anywhere where there's data. These two things can collide. We're absolutely seeing artificial intelligence more broadly being applied to the financial space right now. How do you go through earnings reports more efficiently? How do you make predictions more effectively of where the markets might be going based off of data? And how do you consume that data faster and use artificial intelligence to make inferences from it? So I would actually, in a lot of ways, kind of lump digital assets into a broader financial question of how artificial intelligence can make us more efficient in the financial services. And BlackRock, in many ways, is implementing this in real time. We're using artificial intelligence and applying that to earnings reports to make inferences from what are the companies really saying, what's important, and how is the stock going to react. And this is a really important application of artificial intelligence because ultimately, if you can get more efficient, you can harness more insights from more companies more effectively, then ultimately, you know, you have the potential to be a better investor.
Great. Next question comes to us from Dylan. This is more about the practicality of trading the ETF itself. Say this, so AI, we're talking about long-term investing. When we're selecting an AI ETF, how important is the volume? And maybe you could share what you're seeing with your own thematic ETFs. And will a low volume prevent you from getting out or selling the ETF if needed?
Yeah, it's a great question. So when you see volume in a ETF or in any security, that can be an indication of liquidity, right? How easy is it to get in and out? But with an ETF, it's actually a little bit more nuanced than that because there are some ETFs that don't necessarily trade a lot, but there are market makers behind that ETF that are making a two-sided market. And if someone wants to come in and buy a lot of shares or come in and sell a lot of shares, that market maker can come to a BlackRock or another issuer and create new shares of that ETF to supply the market with the necessary liquidity. So I guess my first rule of thumb is it doesn't necessarily mean what you see on screen with liquidity and the volumes is exactly how much you could trade in that fund. Now, with that being said, I think it's important for investors who are trading an ETF that does have low volume to use limit orders. The importance of this is so that you have certainty in price execution. If you're trying to place a big trade in a thinly traded ETF, that limit order will ensure that you're executing at a specific price and not getting a very bad fill from a market maker. So, you know, but the best of all worlds is to have a highly liquid ETFs that, you know, you can execute in very effectively. So low volume doesn't mean you can't trade in it. I would just be careful that you use a limit order to make sure you have certainty in execution price.
Yeah, that's great insight. And Dylan, you can actually find, we've created videos on all of the different order types, limits being one, stop orders as another choice in our learning center on Webroker. You can go in and learn more about those particular transactions. So, all right, moving on to our next question. This one comes to us from Rachel. Rachel says she's read some concern about AI running out of data to further improve their models since so much of the internet has been scrapped already. How big of a concern is that in your opinion?
Not a major concern. The vast majority of the data in the world today has not been organized and hasn't been utilized. In fact, you know, just think about what data is. Data doesn't necessarily have to be, you know, a picture that somebody tweeted out, right? Data can be handwritten doctor's notes that are sitting in a notebook that's been sitting on their desk for 10 years. Data can be things, you know, how you drive your car and all of this information about when you turn and when you accelerate. Sometimes that data is being collected and processed. A lot of times there's a computer in your car that's running, you know, equations constantly and trying to understand what you're doing, but it's not being stored anywhere. So much of data is being created and then ultimately not stored or analyzed. So I am not concerned that we are running out of data. Data continues to grow exponentially. In fact, more data was created between the years of 2018 and 2020 than in the entire history of the world. So we have more data being created. We have all this digital data that hasn't been processed yet, and then we have all this non-digital data that's just sitting there waiting to be, you know, used in some valuable way. So running out of data is not the concern for artificial intelligence right now.
I would imagine as AI evolves as well, even data that's been organized and analyzed, AI might have a different way to look at it and process it and gain insights from it in the future as well.
That's exactly right. And this is all about the trend of data becoming more valuable. Maybe we looked at it through one lens, but when these AI models become more powerful, it determines that there's actually a completely different meaning to this data. And so, absolutely, I think we can be rerunning the same data with these new platforms and getting new insights from them.
All right, next question comes to us from Bob. Bob says, what are some of the best books or online resources about AI for everyday investors that they may wish to read?
Oh, that's a great question. There are, well, let's see. I mean, I think for anyone who is a thematic investor should look at The Innovator's Dilemma. I think that's just kind of a classic book. There's some great books on the adoption curve, which like Crossing the Chasm, which talks about kind of early technologies and what it takes for them to accelerate and become mass market. I'm sure there are tremendous amounts of podcasts and kind of industry specific journals in the space. I always like to look at kind of what's happening in the startup space as kind of a precursor to what we'll see in the public market. So looking at things like TechCrunch is a really interesting area. But I think the exciting thing about AI is it is in the pop culture now. It is in the mass media. It's very hard to open a newspaper and not read about AI right now. So this isn't there's some themes that I think it's harder to find really interesting, unique information about. AI is everywhere right now. It is being covered very comprehensively. You don't have to look that far to find great content from, whatever newspaper or media sources you use for artificial intelligence updates.
All right, Jay, we're going to have to leave it there. We appreciate you sharing your perspective on one way investors can tap into the AI megatrend. Do you have any final thoughts you'd like to share with our viewers?
No, look, I appreciate being invited on the webinar today. As I mentioned, we are still in the early stages of artificial intelligence, and it's one of the many themes that we see around the world that's creating both disruption but also opportunity for investors. So my final words are, for long-term investors, continue to think thematically about these long-term structural changes, because this is where some of the most powerful opportunities are going to exist in portfolios for the next decade.
All right. Thanks again for joining us. I know I've learned a lot in our time discussing this, and the audience has as well. And for those in the audience, make sure to register for our upcoming live webinars and check out our library of on-demand content. It's available in the Learning Center and on our YouTube page. We'll see you all next time. Have more questions? Check out the links to the right and in the description below.